Most people don't look forward to tax season, but do you want to know what's even worse? Getting hit with a tax that you've never even heard of, just because you had a great year. It's called the net investment income tax, and it's an extra 3.8% that targets passive income for high earners. But here's the good news. With a little planning, you may be able to reduce it or avoid it altogether. In this video, I'm going to walk through what the net investment income tax, or NIIT, is, when and how it applies, some real-world examples, and then 5 actionable strategies to help minimize it in your financial life. And it's frustrating now that just because you work hard and make a certain amount of money, the government is going to take even more from you. And this is a reality that many of my clients face. But I have found that through prudent planning, not only can we mitigate this specific tax, but other taxes that you see within your own financial plan by taking a proactive approach. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. Now, before we go in and talk about the net investment income tax specifically, I want to talk a little bit about capital gains taxes. And I want to start here because effectively controlling for capital gains tax goes a long way in reducing the amount of net investment income, or NIT, tax that you're going to pay. Capital gains come into play when you sell an asset for more than you paid for it. So for example, let's say you bought ABC company stock for $10,000 and a few years later you sell it for $17,000. You effectively have a $7,000 gain on that sale. That is what you're going to be taxed on. Now, if you hold that security for more than a year, you'll pay long-term capital gains tax rates, which are more advantageous. If you hold it for less than a year, you're going to pay short-term capital gains taxes, which are less advantageous because they're taxed at your ordinary income tax rate. And it's important to know what the long-term capital gains tax rates are, because even when realizing gains, if you keep your total overall taxable income below certain levels, you may not have to pay any tax at all on those realized gains. And that's what we want to start controlling for, because controlling for those capital gains will also help you avoid the almost 4% surcharge via the NIT. And if you look at the table here on the screen, you'll see what your capital gains tax is determined by. Typically, it's your filing status and the amount of taxable income you have. So for example, somebody who is married filing jointly and makes less than $96,700 in 2020 in taxable income will pay nothing in the way of capital gains tax. That would also trickle through to your net investment income tax. But controlling for these here becomes more important, specifically if you find yourself in that 15% tax bracket, because if we can effectively keep your capital gains and your earned wages together, which typically make up the majority of your taxable income, below the $250,000 point for individuals who are married filing jointly, then you're going to also avoid the net investment income tax. So that's why I start with capital gains, because this is really the first line of defense and the biggest difference that you can make from both a capital gains tax perspective and the net investment income tax perspective. So what is the NIT? Now, the net investment income tax was originally created in 2010 under the Affordable Care Act, and its purpose was to help fund Medicare by taxing the passive income of higher earning households. It's not a replacement for capital gains tax or income tax, it's a surcharge on top of those. And now this surtax comes to about 3.8%. And the kicker is it's only triggered when 2 things happen. One, you have to earn net investment income during the course of the year. And net investment income is just anything that you earn passively. And we'll go over that in a few minutes here as to what exactly would count as passive income. But just think of things like selling stocks or rental income as the 2 predominant sources of passive income that actually hurts you when it comes to your net investment income. And then after your modified adjusted gross income crosses a certain threshold, and we'll go over those thresholds for whether you're a single filer, married filing separately, and married filing jointly here in a minute as well. But that's what's going to trigger the NIT. So it's not just about what type of income you earn, it's also about how much total income you bring in. And that's why it's so confusing, because it can be triggered by what you make at your job or what you do through asset dispositions. And many people don't look at the whole picture, it's just one or the other. And that's where they get themselves into some trouble. So who does this tax affect? First, let's talk about it from an income threshold standpoint. The net investment income tax will kick in when your modified adjusted gross income, or MAGI, exceeds $250,000 for couples filing jointly, $200,000 for single filers, and $125,000 for those of you who are married filing separately. Once you're over those thresholds, the 3.8% tax will apply to the lesser of your total net investment income or the amount by which your modified adjusted gross income exceeds the threshold. So let's go over a real life example so I can show you how this works with real numbers. So let's talk a little bit about Joe and Jane. Now, Joe and Jane are a married couple who file jointly, and their modified adjusted gross income for this year is $400,000. This includes $25,000 from stock dividends, $50,000 in capital gains, which means that their net investment income is $75,000. Those are two of their sources. And their modified adjusted gross income above the $250,000 threshold is $150,000. That's the $400,000 in modified adjusted gross income they have, less their $250,000 threshold. That's where we're coming up with that $150,000. Now, we know that the net investment income tax is going to be applied to the lesser of those two amounts at a 3.8% rate. So in this case, their net investment income is less than the difference over their threshold. So it's $75,000 is the taxable base for the net investment income tax. So at 3.8% of the $75,000, they're paying an additional $2,850 in net investment income tax on their return this year. That's on top of their normal income and capital gains tax rates. So their capital gains alone, when you include the 3.8% that they're paying on the net investment income tax, comes to 18.8%, or nearly $10,000 on their capital gains position. That's why I always start with the capital gains picture as the first line of defense against the surtax, because if you can effectively control for that, you can keep your net investment income lower, which will limit or mitigate the amount that you'll have to pay in the NIIT tax at the end of the year. So at this point, you're probably wondering what exactly net investment income is. And the IRS considers net investment income as any of the following items: interest and dividends, capital gains, rental income, passive business income, royalties, and non-qualified annuities. Things that aren't included in this calculation are W-2 wages, Social Security, Roth conversions, and distributions from your IRAs or 401ks. And taking it a step further, we need to be concerned about your modified adjusted gross income, which is just your adjusted gross income plus some of the following common items added back. There are others, but these are some of the main ones. The first one being tax-exempt interest, student loan interest deductions, passive loss limitations for business owners who don't take a general partnership stance in the business, rental losses, and non-taxable portion of your Social Security. But here's where it gets tricky. Those non-investment sources can still push your total income higher to trigger the tax on your investment income. So we need to be aware of how everything interplays with each other to keep you below that upper limit of $200,000 if you're a single filer, or $250,000 if you're married filing jointly. So let's take a look at another example now. We're going to talk specifically about Sarah. Sarah's 66 and she's retired. She lives on $80,000 of IRA withdrawals every year, $25,000 from her Social Security, and $40,000 net rental income. Her modified adjusted gross income is $120,000, which is just her IRA withdrawals plus her rental income, plus a portion of her Social Security. Let's say her modified adjusted gross income comes out to $160,000. She's under the threshold for single filer, so even though she had $40,000 in investment income or her rental income here, she doesn't owe on the net investment income tax. But if she took an additional $50,000 IRA distribution next year to fund a home remodel, she'd cross that $200,000 threshold, and that rental income would get hit with an almost 4% tax from the net investment income, which would be about a $1,600 tax that she would have had to pay had she otherwise not taken that extra money from the IRA. So how can you avoid paying NIIT? We're going to cover 5 tried and true methods that I use for my clients each and every year to help mitigate or completely eliminate this burden. I'm also going to cover one bonus strategy I use for clients who are in retirement and not yet collecting Social Security. Let's jump into the first strategy. So the first thing that you want to do is make sure you're practicing tax-efficient investing. This is the first and the easiest way to lower your NIIT, and honestly, this is some of the low-hanging fruit that you can do even without the help of a financial planner. So the way you would want to do this is to make sure you're holding more tax-efficient investments inside of your taxable accounts. Index funds and ETFs are great examples. So are growth-focused stocks with a lower turnover ratio. Some investments that allow for tax deferment, such as annuities, could be a good option here as well. The more you can reduce your taxable dividends and gains in your brokerage account, the lower your exposure will be from a net investment income tax standpoint. Heading a little further down that avenue, the second strategy deals specifically with asset location, which is not just what you invest in, but where you hold it. The idea is to place your least tax-efficient investments like bonds, real estate investment trusts, or heavy dividend funds into tax-deferred accounts like your 401k or your IRA, and keep your more tax-efficient assets like your growth stocks or index funds and ETFs in your taxable accounts. That move could lower your net investment income tax on paper and keep you below that threshold. Next, we're going to talk a little bit about tax loss harvesting, and I think this is the biggest key to helping you avoid the net investment income tax. So consistently harvesting losses and carrying forward any unused loss for future years is one of the most effective ways to not only mitigate your current net investment income tax exposure, but also help lower it in future years. If you've got some losers in your portfolio, especially ones that you don't think have good growth potential, don't let them go to waste. Tax loss harvesting means selling these losers now, collecting that loss, and using that loss to offset gains elsewhere within your portfolio. This can reduce the taxes that you owe from a capital gain standpoint and lower your NIIT exposure. You can even carry forward with unused losses in excess of $3,000 to future years. Just make sure you don't accidentally trigger a wash sale, which disallows the loss if you buy the same security too soon, specifically within a 30-day window. For a more in-depth look into both tax loss harvesting and avoiding the wash sale, check out my videos going over both topics. They will show you how to save money from both a capital gain standpoint and net investment income tax standpoint, as well as avoiding the number one mistake that I see many DIY investors doing, which is invoking a wash sale because they aren't aware of the rule. If you're planning to sell a large asset, the fourth strategy would be to time that sale strategically. So if you're thinking about selling something like stock, your business, or maybe you have a house that's appreciated in excess of the capital gains tax exclusion, you may want to time those sales a little bit more carefully. For example, if you're retiring next year and your income will drop significantly, it may make sense to delay the sale until then. That way, your modified adjusted gross income stays below the threshold and you avoid the net investment income tax altogether. You can also spread gains across multiple years when possible by using something like an installment sale or structured payouts. This effectively stretches the burden over many years as opposed to having one lump sum payment due in any one given year where you're going to incur a significant portion of that as net investment income. The fifth strategy is using charity to your advantage. So giving to charity can do more than just feel good. It can also reduce your net investment income tax liability. If you're already planning to give, consider a donor advised fund. In the donor advised fund, you contribute appreciated assets like stocks. You get a deduction in the year that happens. You avoid paying capital gains tax on those charitable gifts and reduce your modified adjusted gross income in the process. This works especially well in years with unusually high income or big gains. Now for the bonus strategy, which is to utilize Roth conversions in low income years. Let's say you're between jobs, you're just retired, you're planning to take Social Security a little bit later on, and you're over the age of 60. This is a golden window for Roth conversions. Why? Because you can convert pre-tax IRA dollars to Roth without triggering the net investment income tax. And it reduces future required minimum distributions, which otherwise might push you into having to pay the net later on in retirement. It's a way to pay taxes on your terms instead of the IRS's, and it'll probably lower your exposure and your overall tax burden throughout the rest of your life. The net investment income tax is one of those taxes most people don't even know about and don't even see coming. It will quietly eat into your investment returns, especially during high income years. But if you plan ahead, whether through investment choices, account location, or income timing, you can reduce or avoid it altogether. If you're unsure how this might impact your retirement plan, that's exactly the kind of thing that I help my clients with. Thank you so much for watching. If you found this video helpful, hit the like button, subscribe, and I'll see you in the next video.